from global perspective and how things are opening up for 2010. Geoff Lewis, Head of Investments at JPMorgan Asset Management, is with me now. Geoff, morning. Thanks for joining in. How was 2010 looking for equities to you guys at JPMorgan?
This recovery is it's disappointing by past historic standards of the bounce from a deep post-war recession, but considering the enormity of the crisis faced in 2008, we've done pretty well. We're coming through. So from that point of view, I think equities are the place to be, but you're obviously not going to get another 60% from emerging markets or another 30% from global equities. It'll be a lot less than that. And probably consensus now, I think, that it'll become more difficult as the year progresses.
What about flows, though, Geoff? In terms of FI flows, we had a terrific year in 2009. Do you see that kind of interest coming in 2010? And would it be still the ETFs which are driving money, or you see a lot of interest from long-only and even hedge funds?
It's been a record inflow, yes. So I think that I saw a figure of 75 billion, but that was after an outflow of 55 billion in 2008. So, taking the 2 years together, it does not look excessive. But I think emerging markets and the governments in those countries are worried about the possibility of too much capital flowing in. And certainly the difference in relative fundamentals between the emerging markets and the developed or advanced economies has never been more strongly in favor of the emerging markets. So on those reasons alone, and also with currency expectations that emerging market currencies are undervalued, there are certainly strong reasons for capital inflows to continue. Quite a lot of the long-only crowd now are actually overweight, and according to the Merrill Lynch survey of global fund managers, but there is still a lot more cash to be invested. Looking at, say, US money market assets relative to stock market capitalization, it's come down a long way, but it's still a long way above normal pre-crisis levels.
What about the dollar? That's rebounded from 74 to 78 plus. Do you think that negative correlation with equities has broken down for good, or does it remain a concern area for you, a strong possibility of a bounce back in the dollar?
I think the dollar carry trade is not, in the sense that U.S. interest rates are going to remain low for a long time, and probably countries like India and China will be tightening their monetary policies ahead of the US. So from that point of view, I don't think there's anything to stop the carry trades from continuing.
How are you guys calling the Indian market for 2010 then at JPMorgan?
Well, sense is we are a little bit more concerned now because obviously inflation is coming through earlier and stronger. And the RBI is normally proactive when it comes to managing inflation risks. So it will be raising interest rates in the first quarter. But nevertheless, that in the last interest rate upcycle, the equity market continued to rally well into that interest rate cycle because at the same time, the Indian economy is doing well. Earnings have recovered, growth has recovered. So on balance, I think one would not want to be negative about the Indian stock market purely because there will be some preemptive moves to adjust monetary policy to take away some of the ease. That is just sensible. In the longer run, it should lead to a more sustainable rally for the Indian stock market. So investors should welcome a responsible, proactive Reserve Bank of India.
What then, to your mind, is the key risk to the bullish scenario that you're painting for equities?
Well, there are a number of risks. obviously there's a risk of, if you see, say, a temporary burst in US or European activity due to inventories, which central banks confuse as a vigorous rebound, and central banks then start to tighten policy too early, that is one risk. The other risk, of course, is that the fiscal stimulus wears off in the advanced economies, and there is no private demand follow-through, and those economies start to decelerate in the second half of 2010 and perform poorly, so that there are doubts that there is a sustainable recovery going on at the global level. Most of the risks on the activity sides to the emerging markets are obviously external. The main risk that the emerging markets face are internally would come from domestic inflation. They didn't suffer such a large downturn in the real economy. They didn't have such large output gaps or excess capacity, and the strong growth that they're experiencing is bringing many of those economies closer to full employment. So policymakers need to recognize this. They need to tighten in the emerging market universe ahead of the advanced economies on this occasion. So emerging markets very much should be in the lead in this policy cycle, not in the vanguard. Not in the rear.
So you would still say that your favorite asset class going into 2010 would be equities? It won't be fixed income or even commodities or precious metals?
Well, that's quite simple to us. We see very poor value in government bonds generally. There's no decent return from cash. So with the recovery likely to continue, in our view, it has to be equities. Obviously, you should look for a much lower return than 2009, which was pretty much just a bounce from really depressed levels after the crisis. You always get that after a major banking crisis. So much lower returns, more volatility probably, and it's going to be very difficult to time the short-term movements. So best bet is for investors just to stay fully invested through the year, grit their teeth, accept the volatility, but hope to end up, say, with decent upper single-digit returns by year-end. Not a terribly exciting prospect, but too soon to be too defensive on the equity front, I think. And we're still going with the flow. We're still going with emerging markets, Asia ex-Japan. It seems to be consensus, but I don't think it's right to take a strong contrarian view on this key issue just yet. There's a lot more money that could come into these markets and drive valuations to levels which historically look rich, as in the early 1990s.
Thanks, Geoff, for your perspective as always. That's JPMorgan telling us that they're bullish, but moderately bullish going into 2010, but equities is still the place to be.